Hello dear students, in this video we are going to see the cash flow statement. Myself Professor Vaishali Bharat Golab. See, cash flow statement. Why there is a need to prepare the cash flow statement? In previous video, we have covered the income statement and balance sheet. These final accounts or financial statement helps for measuring the trading performance, operational efficiency, profitability, financial position of the business. These financial statements are prepared to find out gross profit, gross loss, net profit, net loss, and financial soundness of a firm as a whole for a particular period of time. But management, creditors, investor wants to know the cash position of the organization. Okay, and it is not possible to understand the cash position from this financial statement, that is income statement and balance sheet. See, income statement is prepared based on accrue system. Means in income statement we record the two types of transaction, that is cash transactions and credit transactions. In cash transactions we will get back the cash and also we have to pay the cash immediately. But in case of credit transactions, cash payment and cash receipt are occur after the after some times. That's why it is very difficult to understand the cash position of the organization on particular period. That's why there is a need to prepare the cash flow statement. What is cash flow statement? Cash flow statement is a statement showing inflow and outflow in a particular period of time. That is known as cash flow statement. Here in cash flow statement, we record cash and cash equivalent. Cash equivalent include, or cash equivalent means uh, those part which are converted into cash immediately or within some time period. That is cash, check, demand draft, short-term investment, short-term deposit in bank, marketable securities are some of the cash equivalent. Now, what is meant by cash flow? Cash flow is nothing but the movement of cash in and out due to some non-cash items or non-cash transactions, that we call it as a cash flow. Cash flow include cash inflow and cash outflow. Cash inflow means the transactions in which cash is coming into the business. For example, cash from operation, sale of fixed asset for cash, sale of investment for cash, raising long-term loans from bank, issues of shares and debentures. These are the sum of the transactions in which we receive or cash inflow is occur. Then cash outflow means the transactions in which cash is going out of the business, that is cash lost in operation, redemption of shares and debentures by cash, purchase of fixed asset by cash, repayment of long-term loan and investment of security by cash. These are the some of the transactions in which cash is going out of the business, that is cash outflow. Now, as per the account standard, cash flow, to represent the cash flow, the different activities are involved. As we have know, there are various activities of the organization, of an organization or firm result into cash flow, that is cash inflow and outflow, which is the part of cash flow statement. Okay. As per the account standard 3, these activities are classified as operating activity, investment activity and financial activity. Okay, operating activity, financial activity and investment activity. These activities helps the user of cash flow statement to assess the impact of this activity, that is operating, investment and financial activity, on the financial position of an business, of an enterprise or business or firm. Okay, as on its cash and cash equivalent. Okay, now operating activity. What is meant by operating activity? The operating activities are the activities that constitute the primary or main activity of an enterprise. For example, cash inflow occurs by proceeds from sale of goods and services to customers, receipt from royalty, fee, commission and other revenues. Then cash outflow occurs: payment of employee benefit expenses, purchase of inventory from supplier, payment of operating expenses, payment of taxes. Then investment activity. Investment activities are the acquisition and disposal of long-term assets and other investment which are not included in cash equivalent, that are come under investment activity. For example, sale of property, plant, equipment, long-term investment. And receipt from interest and dividend, these are the cash inflow. Then cash outflow: purchase of property, plant, equipment and non-current investment. Now financial activity. Financial activities are related to the long term funds or long term loans or capitals of the business, or from where the capital is generated, that are included in financial activities. Okay, for example, cash inflows are proceeds from issue of preference or equity shares, proceeds from issues of debt and bond, procurement of loans. Then cash in outflow: redemption of preference share, buyback of own equity shares, redemption of debentures and payment of the long-term debt, payment of dividend and interest are the cash outflow representing the financial activity. Now, this is the pro forma of cash flow statement. Cash flow statement is a statement showing cash inflow and outflow of the business. Okay, cash flow start with opening balance. Opening balance as in the form of cash and the bank balance. Then we record the cash inflow. Cash inflow is fresh issue of shares, issue of debentures, raising long-term loans, sale of fixed assets, sale of investment, dividend received and cash from, that will give the cash from operation. Then cash outflow. Cash outflow: cash lost in operations, redemption of preference share, redemption of debentures, repayment of long-term loans, purchase of fixed asset, purchase of investment, tax paid, dividend paid, and then we will get the closing balance, that is cash and bank. Okay, cash from operation we will calculate from the adjusted profit and loss. Okay, this is the pro forma of cash flow statement.